Hi, I'm Donnie Hall, a partner at Kaplan Fox, and I will be your host as we present the 25 Red Flags Weekly series, where we will review a number of issues that are often the foundation for fraud and lead to litigation. Our topic for week 2 is when growth moves too fast. Everyone loves growth. Investors chase it, analysts reward it, and management teams build their careers on it. But here's the uncomfortable truth. Not all growth is healthy. In fact, some of the most spectacular corporate failures in the last 2 decades started with explosive growth. Today, we're breaking down why growth that moves too fast can be one of the strongest early indicators of accounting manipulation, or worse, outright fraud. Because the real question isn't how fast are they growing, it's how are they growing. Every management team feels the pressure to keep the growth story alive. In bull markets, companies are rewarded for momentum, not fundamentals. Investors demand quarter over quarter acceleration. Analysts build models that assume compounding expansion. And suddenly, executives start optimizing for optics instead of economics. This pressure breeds distortion, pulling forward revenue, channel stuffing, overstating pipeline conversions, delaying expense recognition. The playbook is predictable. It starts with aggressive guidance, ends with non-GAAP adjustments, and somewhere in between, the accounting starts bending reality. The takeaway? Fraud rarely begins with desperation. It begins with expectations. Let's look at an example that illustrates this perfectly. A mid-cap biotech company, we'll call it Helix Therapeutics, went public with a promising pipeline and early FDA momentum. Within 2 years, revenue had tripled. Analysts couldn't stop raising price targets. Institutional investors were increasing their positions. But behind the numbers, the company was pushing product out the door faster than demand warranted. Distributors were sitting on unsold inventory, while Helix kept booking revenue as if it were end user consumption. The result? A textbook case of channel stuffing, pushing sales through the channel just to hit growth targets. When the regulators stepped in, restatements followed. The CFO resigned, and the stock lost 80% of its value in 6 months. Everyone said no one could have seen that coming. But the truth is, the signs were right there. Growth rates disconnected from industry averages, ballooning accounts receivable, and inventory piling up faster than revenue. So, how can institutional investors tell the difference between authentic expansion and aggressive accounting? Here's the framework we recommend. 1. Compare growth against cash flow. If revenue is growing 30% a year, but operating cash flow is flat, that's not growth, that's fiction. 2. Benchmark against peers. When one firm grows twice as fast as every competitor in the same sector, it's not always innovation. It might be manipulation. 3. Watch for channel inventory. Distributors, wholesalers, or partners holding months of product while management still reports strong sell through is a major red flag. 4. Monitor non GAAP adjustments. Phrases like adjusted revenue, core earnings, or normalized earnings often exist to hide volatility. 5. Track days sales outstanding. Rising days sales outstanding equals slower cash collection. That often precedes restatements or write offs. The more these indicators cluster, the more you should shift from enthusiasm to scrutiny. Here's the lesson from week 2. Fast growth isn't always good growth. Healthy growth is supported by cash, consistent reporting, and transparent accounting. Unhealthy growth is built on borrowed demand, deferred truth, and management's need to keep the story alive. As fiduciaries, the job isn't to chase the fastest stories, it's to protect our investors from the ones moving too fast to be real. I'm Donnie Hall from Kaplan Fox, and this has been week 2 of the 25 Red Flag series. Next week, we'll unpack why CFO departures often precede financial restatements and how you can spot the signal before the market reacts. See you then.